Well, Canacol Energy was founded in 2008, initially as a private company, 2009. We went public with a listing on the Venture Exchange in Toronto. We have since migrated up to the main board in Toronto, and we also have a listing on the Colombian Exchange in Bogota. We're a company that currently produces about 19,000 barrels of oil equivalent per day. And that's largely natural gas, although we produce about 3,500 barrels of oil, of light oil production from our assets in Colombia and in Ecuador. We saw this opportunity back in about 2011, where we made basically the strategic decision to acquire gas assets in northwestern Colombia, specifically in the Lower Magdalena Basin. This was at a time when we were a pure oil producer and saw the opportunity to diversify our production base by acquiring gas assets. The gas assets, it was a producing asset along with a sales contract, was generating cash flow. But what was of particular interest to us was the running room, the remaining exploration potential on the lands, and that we've recently supplemented with a further acquisition of prospective acreage that surround those original lands that we picked up in 2011. The opportunity is the growing demand for natural gas in Colombia, particularly in the markets along the Caribbean coast, where we have secured a number of contracts to sell gas primarily to thermoelectric power generating utilities, but also into local mines as well that use our gas as a fuel source to power their operations. The opportunity for us at this time is that we sell gas into a number of fixed price long-term contracts. And that, of course, is an advantage to us at a time of uncertainty around oil price. Well, first of all, it has to be said that Colombia is richly endowed with hydrocarbon. It was one of the key decision criteria for going to Colombia in the first place, along with other important criteria such as political stability, strong regulatory administration, and favorable fiscal terms. But at the end of the day, it's all about where the oil and gas actually is. And Colombia is certainly blessed with plenty of both. We are an exploration company. We set about the sort of founding premise of the organization is that we would grow organically by means of exploration. And we've had a great deal of success in that regard, both in oil and in natural gas, particularly in our oil position in the Llanos Basin, where for the first few years of our history, we were quite focused on building our light oil position there. But since 2011 and the acquisition that we made of the so-called Shona assets, which are the gas assets in the northwest part of the country, we've enjoyed a great deal of exploration success there as well. And to answer the question specifically, we believe that, yes, we can sustain our exploration success going forward, given the running room that we have both in our natural gas assets and also on our light oil. We're engaged in two specific play types, which in the natural gas project has already yielded 4 successes from 5 attempts. And we have an inventory of 40 to 50 prospects, well defined on 3D seismic, in a play type that we believe we understand in great detail. On the oil side, similarly, we've enjoyed success in the order of 4 successes for 5 attempts. And on our 3D seismic across our light oil position, we see remaining potential that we can turn to in the event that oil prices should firm up. And we would like to see them firm up and sustain between $55 and $60. But in the meantime, we have an ambitious exploration program focused on our gas assets, already underway for much of this year, and we imagine keeping up to 2 drilling rigs busy pursuing our gas opportunities across our position in the Lower Magdalena Valley Basin. The current split is about 20% oil and 80% gas. As recently as last year, it was about 70% oil and 30% gas. The beginning of this year, we increased our production on the natural gas side as a new pipeline from our facilities, our gas facilities, to market in Cartagena had been constructed and was being commissioned. So we've seen our production build this year in natural gas from what was about 20 million cubic feet of gas a day to what is now 90 million cubic feet of gas a day. And that naturally has displaced the relative percentage of oil production to what is now about 20% of the total mix. Having said that, of course, historically we were an oil producer. So up until at least 2011, when we acquired the gas asset, we were 100% oil producer. And until very recently, I would say in the order of 80 to 20% oil over gas. That, of course, has switched as we've taken advantage of being able to flow gas into these long-term contracts where we have negotiated fixed pricing that is in the order of about $5.60 per MCF on average. And we net back about $4.60 per MCF on our natural gas. So that, of course, is very competitive relative to what we're realizing in terms of our oil netbacks right now, which are in the order of $18 to $20 a barrel. We consider our E&P peers to be fellow Colombian operators. And quite simply, what differentiates us from our fellow Colombian operators is our production mix. Almost exclusively, I would say, other Colombian operators are pure oil producers. And we have the benefit of having a mix between oil and gas, where over the last couple of years our attention has been very much focused on our natural gas assets by virtue of the fact that we can produce into these long-term gas contracts at this fixed pricing of $5.60 per MCF. Such that we're net backing $4.60 per MCF. That pricing is assured. It is not subject to the volatility of oil price. And so right now we differentiate ourselves from our peers insofar that we are assured of a predictable cash flow going forward, which incidentally for this year will be in the order of about $135 million of EBITDA. And with a full calendar year of gas production at 90 million cubic feet of gas a day in 2017, next year, we anticipate EBITDA to be in the order of $175 million, of which about 150 will be exclusively related to our natural gas production.